Fundamental Analysis for Beginners, a step by step guide. Fundamental analysis is a key tool for understanding the long term health of a company. This video guides beginners through the essential steps of fundamental analysis. Fundamental analysis is a key tool for understanding the long term health of a company. This video guides beginners through the essential steps of fundamental analysis, making it easy to apply this powerful tool to your investment decisions. The three main financial statements are essential tools for understanding a company's financial performance and position. Each statement provides unique insights and serves a different purpose for stakeholders such as investors, creditors, and management. Here is a brief introduction to each of them. First, income statement. The income statement, also known as the profit and loss (P&L), summarizes a company's revenue and expenses over a specific period, typically a quarter or a year. It provides a clear picture of the company's profitability by showing how much money was made, that is revenue, and how much it was spent, that is expenses. The key components of an income statement includes revenues, the total income generated from sales of a goods or services. Cost of goods sold, COGS, direct cost attributable to the production of goods sold. Gross profit, that means revenue minus cost of goods sold, COGS. Operating expenses, cost incurred in the normal course of business such as salaries, rent, and other utilities. Net income, the final profit or loss after all revenue and expenses have been accounted for, often referred as the bottom line. Second one, balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point of time. It outlines what the company owns, that is assets, what it owes, that is liability, and the residual interest of the owner, that is equity. The balance sheet follows the accounting equation asset is equals to liabilities plus equity. Key components of balance sheet include assets, resource owned by the company, categorized into current, that is cash or inventory, and non-current, that is property, equipment. Liabilities, Obligations or debt owed to external parties, also categorized into current, that is account payable, and long term, that is bond payable. Equity: the owner's claim on the assets after liabilities are deducted, which include common stock, retained earning, and additional paid in capital. Cash flow statement. The cash flow statement tracks the flow of cash in and out of a company over a specific period. It provides insight into the company's liquidity and cash management, highlighting how cash is generated and used in operating, investing, and financing activity. The cash flow statement is divided into three sections. Operating activities: cash flow from the core business operation, including receipts from customer and payment to suppliers and employees. Investing activities: cash flow related to the acquisition and disposal of long-term assets such as property, equipment, and investment. Financing activities: cash flow from transaction with the company's owner and creditors, including issuing stock, borrowing, and repaying debt. Now, fundamental analysis tools help investors evaluate a company's financial health and performance. Here are 5 key tools with simple examples. First one is earning per share, that is EPS. It measures a company's profitability. For example, if a company earns rupees 1 million and has 1 million shares, then its EPS is rupees 1. Price to earning PE ratio. It compares a company's share price to its earning per share EPS. If a stock is priced at rupees 20 and its EPS is rupees 1, the PE ratio is 20. Return on equity, ROE. It indicates how effectively a company uses equity to generate profit. For example, if a company has 1 million in equity and owns rupees 2 lakh, its ROE is 20%. Price to book, PB ratio. It compares a company's market value to its book value. If a company's market value is 1 billion and its book value is 500 million, then the PB ratio is 2. Dividend yield. It shows how much a company pays in dividends relative to its stock price. If a company pays a rupees 1 dividend and its stock price is rupees 20, the dividend yield is 5%. Fundamental analysis tools are essential for the investors to assess a company's financial health and make informed investment decisions. Let's have a quick revision. Now, as earlier we have discussed, similarly, furthermore, we have a brief discussion on this topic: earning per share, EPS. Definition: it represents the portion of company's profit allocated to each outstanding share of common stock. Example, if a company reports a net income of rupees 2 million and has 1 million share outstanding, the EPS would be rupees 2. Price to earning PE ratio. Definition: a valuation ratio calculated by dividing the current share price by the earning per share. Example, if a company's stock is trading at rupees 30 and its EPS is 3, the PE ratio will be 10. Its formula is MPS by EPS, means 30 divided by 3 is equals to 10. Return on equity ROE. Definition: it measures a corporation's profitability by revealing how much profit a company generates with the money shareholders have invested. Example, if a company has a net income of rupees 5 lakh and total equity is rupees 2 million, the ROE, return on equity, would be 25%. Price to book PB ratio. It compares a company's market value to its book value, indicating how much investors are willing to pay for each dollar of net assets. Example, if a company's market capitalization is rupees 800 million and its book value is rupees 400 million, the PB ratio would be 2. Dividend yield. Definition: a financial ratio that shows how much a company pays out its dividend each year relative to its stock price. Example, if a company pays an annual dividend of rupees 2 per share and its stock price is rupees 40, the dividend yield would be 5%. When fundamental analysis metrics are high, it often indicates strong financial health and performance, suggesting the company may be undervalued or a good investment. Conversely, low metric can signal potential issues such as poor profitability or overvaluation. Ideal values vary by industry, but generally higher EPS, ROE, dividend yields are favorable, while lower PE and PB ratio can indicate undervaluation. High and low metrics in fundamental analysis. Earning per share EPS. High EPS, it indicates strong profitability. A high EPS suggests that the company is effectively generating profit for its shareholders, which can lead to increased investor confidence and potentially higher stock price. Low EPS, it may signal financial struggle or inefficiencies. A consistently low EPS could indicate that the company is not managing its expenses well or facing declining revenues. Price to earning PE ratio. High PE ratio, it often reflects high investor expectation for future growth. However, it can also indicate that the stock is overvalued if the earnings do not justify the price. Low PE ratio, it may suggest that the stock is undervalued or that the company is experiencing difficulties. Investor might find low PE stocks attractive if they believe the company can improve its earnings. Return on equity ROE. High ROE, it indicates effective management and strong profitability relative to shareholders' equity. Companies with high ROE are often seen as good investments. Low ROE, it can suggest inefficiency in generating profits from equity. A low ROE may raise concern about management effectiveness or the company's ability to generate returns. Price to book PB ratio. High PB ratio, it may indicate that the market values the company highly compared to its book value, often due to strong growth prospects. However, it can also suggest overvaluation. Low PB ratio, often seen as a sign that the stock is undervalued. Investor may consider low PB stock as potential bargains, especially if the company has solid fundamentals. Dividend yield. High dividend yield, it indicates that a company is returning a significant portion of its profit to shareholders. This can attract income focused investor, but it may also raise concern if the yield is high due to falling stock price. Low dividend yield, it may suggest that the company is reinvesting profits for growth rather than paying them out as dividends. This can be favorable for the growth oriented investor but may not appeal to those seeking immediate income. Thank you for watching this video.